Crypto versus stocks, which is better for investment? Stocks and cryptocurrencies are dramatically different investment assets. While both are generally liquid assets that belong in the speculative side of your portfolio, the similarities end there. But before moving forward, don't forget to subscribe our channel. These are very different types of securities and belong in very different parts of your portfolio. Here's a summary of these two types of securities. A financial advisor can help you decide whether either or both of these are a good fit for your portfolio. But what are stocks? Stocks represent ownership in a publicly traded company. Each share of stock you buy confers a percentage of ownership in the company itself. You receive this ownership in proportion to the number of shares that a company has issued. For example, say that XYZ Corporation releases 50% of its ownership in the form of 50 shares of stock. If you buy one of these shares of stock, you will literally own 1% of XYZ Corporation. While uncommon, when a company has released more than half of its ownership in the form of stock, it is possible to acquire the firm simply by purchasing enough of its stock. An investor can make money by selling their stock shares to other investors. This is known as capital gains, the difference between what you paid for the asset and what you get from selling it. Beyond that, the benefits that you get from owning stock depend entirely on the individual company involved. Stocks can also gain value by paying dividends to their investors through voting power held by shareholders and by other rights of ownership. Every individual company is different in terms of how, or if, it handles issues like dividends and shareholder voting rights. What are cryptocurrencies? A cryptocurrency is a purely digital asset. This means that it has no physical component but rather exists only as entries in an online ledger recording ownership. This is, for example, as opposed to the US dollar, which has both a physical component. You can withdraw and hold a dollar bill, and a digital component. You can own a dollar as nothing more than an entry in your bank account recording that ownership. The individual unit of a cryptocurrency is called a token, in the same way that the individual unit of a stock is called a share. Cryptocurrencies come in two main varieties. Some, like the well-known Bitcoin, are intended as pure currencies. They exist only for people to trade, buy, and sell. Others, like Ethereum, are what is known as utility tokens. These currencies function as part of a more complex piece of software, although utility tokens are also meant to be bought, sold, and traded. At time of writing, there are several thousand different cryptocurrencies in circulation. Key differences. For an investor, there are critical differences between investing in cryptocurrency and investing in stocks. However, as a threshold matter, it is important to understand that this video is merely a brief introduction to the issue. You could write volumes on the nature of crypto versus stock investment, and people have. Next is diversity. Both stocks and cryptocurrencies offer thousands of potential investment opportunities. At the time of writing, the combined listings of the New York Stock Exchange and Nasdaq alone offered more than 6,000 potential companies in which to invest. At the same time, various cryptocurrency marketplaces offer between 10,000 and 12,000 potential cryptos. However, these markets are not necessarily as diverse as they appear. At any given time, somewhere between 55% and 70% of the entire cryptocurrency market is tied up in Bitcoin. That one asset dominates this market in a way not seen among stock exchanges, where almost any company can be a potentially valuable investment. That said, stock markets shouldn't get too proud of this distinction. While no one stock dominates its market, there are similarities in the FANG stocks. These 5 companies: Facebook, Apple, Amazon, Netflix, and Google make up roughly 1/5 of the entire S&P 500. It isn't the dominance of Bitcoin, but investors should be aware of similar market capture dynamics. Next is profit source. You can generally profit off of stocks in 2 ways. First, you can make capital gains by selling your shares to another investor for more than you paid. Second, you can hold the stock and collect dividends if the company behind the stock chooses to make dividend payments. From time to time, a company may buy back its own stock, creating a more guaranteed form of capital gains. You can only collect profits off cryptocurrency through capital gains, while utility tokens offer a complicated series of software solutions. Ultimately, any crypto on the market can only be turned into dollars by selling it to another investor. Furthermore, despite nearly 10 years' worth of industry-wide development, at time of writing, no utility token has turned its software into a marketable product. This makes cryptocurrency somewhat more speculative than stocks tend to be. A pure cryptocurrency, ultimately, is only worth what the next investor is willing to pay for it. There is no underlying asset to influence or stabilize that value. This means that cryptos are subject only to technical analysis. Stocks, on the other hand, have an ungrounded asset in the form of the company behind the shares. This creates room for fundamental analysis on a stock's value, as you can evaluate what the underlying company is worth regardless of market dynamics. Trading and regulation. Like all securities, stocks are some of the most heavily regulated assets that you can trade. The SEC monitors public shares closely and does the same for the markets on which those shares are traded. Investors trade most stocks on a handful of large, centralized exchanges. Almost all stock trades in the United States, for example, are conducted on the New York Stock Exchange and the NASDAQ. Any given stock will only be listed on one exchange at a time. While you can trade shares privately, this is relatively rare and typically done only with unlisted and penny stocks. Cryptocurrencies do not yet have any kind of centralized exchange system. Instead, a network of hundreds, if not thousands, of independent companies run their own small exchanges where individuals trade cryptocurrencies among themselves. Although a few more popular cryptocurrency exchanges dominate coverage, there are no truly dominant players in this market. This means that cryptocurrency is traded among individuals. Unlike the formalized stock exchange system, in which shares are traded through a third party known as a clearinghouse. Most, if not all, cryptocurrency is traded directly between the buyer and seller. While many advocates of cryptocurrency argue that the technology behind cryptocurrency has made clearinghouses obsolete, this is untrue. A clearinghouse functions as a middleman that brings buyers and sellers together. That helps to establish clear market prices for each asset. And at last, thanks for watching.